Hello, today we will be speaking about a risky asset and a risk-free asset. So, to do that, first of all, we go to Yahoo and download the weekly closing prices of two stocks. Let us take Google, you can see here, equity NMS, this is Nasdaq, and similarly, we can take a different industry, say Walmart. Okay, that is in NYSE. Okay, and if you click on that, just click on Walmart. Okay, you get this page as such. Go to historical data, and here you get period. So the time period. So what you do is you go over here and click on 1 year. Right, change the frequency from daily to weekly, apply it and download it. Okay, so that exercise I have done and downloaded the details of both Google and Walmart for 1 year. You can see for 1 year, right? What is the next thing? Next thing is you also need to know as to what is the risk-free rate in USA. So T-bill rate in USA today. So what do you get? See, the bill right now it is around 5.28, 5.28, 5.27. That is the one. I mean, yesterday when I was checking it, it was 5.27. Okay, let us take it as 5.28. Okay, risk-free rate is 5.28.0528, right? And this is a yearly one. Now, since all our data is on a weekly basis and all our calculation will be on a weekly basis, we will take it on a, so this we just divided by 52. Okay, this is one exercise that we have now done. Now what we need to do is we need to calculate the returns. Okay, returns of both Google and Walmart. Okay, so how do you do that? It's very simple. You just do equal to the reading on the left side divided by the previous one minus 1. Okay, so this gives you a reading. Just make it percentage, increase the decimals to your liking, copy the same thing, paste the same thing on Walmart. Having done that, now you can go down to level till where the readings of both Walmart and these are in existence. Okay, and I will add another space of column so that some of the calculation that I need to do, I will do it over here. Now, having calculated the returns as such, we need to take the mean for the period. Okay, so mean, how do you calculate mean? In Excel you have a formula. Okay, you can either directly tap equal to AVE and it will guide you to the available definitions that are there. You just calculate, just click on average, go to the first cell, and from there you can come till the last cells, bracket closed, and this average that you get is the mean for the period. Okay, you can copy this and paste this for Walmart too. So this is the mean for Walmart. Okay, we also have on the left side we have already calculated the risk-free rate and the risk-free weekly rate too, right? If you want to convert these two into percentages, you just need to do this and just bring it down to bring it by 2-3 decimals so that you are able to see it. Okay, one is mean, the other is variance. When you calculate variance, variance is nothing else but the dispersion from the mean either on the upside or on the downside. It doesn't matter whether it is upside or downside in as far as variance is concerned. Okay, so we can calculate variance. This is just for the academic purpose here rather than anything else, because here we need standard deviation more. However, variance is something you can calculate by doing this thing. There is a function called as fx function. Okay, you here always bring it to not most recently all. Go to VAR, type VAR, go down. There is something called as VAR.p. This is VAR for population. Again, what are the set of records that you will take for the purpose of calculation of VAR? You will take it right from F3 and scroll down till your last reading. Okay, and you just do enter. So this is the variance of Google and this is the variance of Walmart. You can also do standard deviation. They can be done by two ways. Either you can square root the variance, or you can also do is you just go to function, go to std, and you have std dot. Again here you can go from here till the you start from here till the end and you just do enter. Both will give you the same reading. Okay, so we will take this and the same will be copied for Walmart too. Now since there are two stocks, there has to be a correlation between these two. So there is something called as correlation. We will calculate that too. For that you need to type CORREL, or otherwise you go to the fx function above. So first of all you give this array and then comma, and then you give the second list of array, close the bracket, you get a correlationship here. Okay, now all the calculation will be on the top of the page. So what I will try to do is I will try to, okay, this was not required, so I'll just remove this column. Okay, now this is E56. Okay, so I'm trying to bring in the E56. So what I've done is I'm just bringing those readings on the top. I can do this by either typing the address of that specific cell or say equal to and go there to that specific cell and click on it, right? So I get mean. I can just shift it one level down to know as to what pertains to which. So this is mean. So all those readings have been captured. I will also bring in the risk-free rate and weekly. This is C56 and I can write it as RFR weekly. This is equal to C56 and this is equal to This is just copy and put it over here, right? Just confirming whether the cell address is right. Okay, C56, yes, it is right. So having done this, now what we need to do is, now we need to calculate as to what combination of Google and Walmart will give us good return at a lower standard deviation. For that, what we do is we calculate various weights. Here, let us beginning by, again I will take this name over here. Then I will, the third column is RP, this is the expected return, and this is standard deviation. Okay, so what I am doing is, let us say that we want to start Google on a negative note. Remember, the weights will always be equal to 1. What I mean to say is that the total of the weights of Google and total of weights of Walmart should be equal to 1. So let us say that I take minus 0.7 and I say is equal to 1 minus this. Okay, so this basically means if I am negative 70% on Google, how do you become negative 70% on Google? You sell it short. So when you are selling it short, you receive money. You are receiving $70. You had $100 to start with. Now you have $100 that you originally had plus the $70 that you used to short Google to now buy Walmart to the extent of 170%. Okay, so $170. So I will do one thing is that I will now just say this plus 0.1. Okay, and I will follow this procedure till say around 140%. We started with negative Google, and whatever we received from the short sale of Google, we added it to buy Walmart. To the extent of going the other way, we went to around 140% of Google and minus 40%. So we shorted Walmart to buy Google. Now let us now come into how do you calculate the expected return of this portfolio. So remember, we already know as to what the mean is. You can see in from J1, J2 and K2. These are the mean of Google and Walmart. So you do in cell number K10, you see is you do equal to take the weight of Google multiplied by the mean. Remember, you need to fix this cell. Why? Because this mean will be required for the calculation of all the cells below in this column K, starting from K10 to around K31. Okay, so I will just do F4. Okay, plus weight of Walmart multiplied by the mean of Walmart, again locking the cell, closing bracket and finishing up. Okay, I can change this to percentage and increase the decimals this way. Now standard deviation is slightly tricky, but it is a very simple one if you just put your mind properly to it. Once you know as to what the formula is, this formula works in most of the places. It is equal to, I start with double brackets, double open brackets. I take the weight, multiply it with the standard deviation of Google. I took the weight of Google, multiplied it with the standard deviation of Google. I need this to be fixed, so I do F4. I close it, raised to the power of 2 plus, I open the bracket here again. Now I take the weight of Walmart, multiply it with the standard deviation of Walmart. Again I fix it, close the bracket, raised to the power of 2 plus 2 times weight of Google multiplied by weight of Walmart multiplied by the standard deviation locked, multiply standard deviation of Google, now the standard deviation of Walmart, again I lock it, and the correlation between Google and Walmart, okay, again I lock it, okay. Now what has happened is this will basically give me a variance, but I need a standard deviation. So what I do is I raise it to the power of 1 divided by 2 and close the bracket. This gives me a standard deviation, okay. Now this standard deviation, again, since I have locked all the cells, I presume, so I'll just check in F2, J, K, and yeah, seem to be fine. So I'll just copy this to the rest of the cells. So we have a range right from -70 on Google to going up to 140% in Google, right, and Walmart plus 170% to -40, and these are the various weights given the mean as to what is the expected return. Now as you all know already, that Sharpe ratio is the difference between the expected rate minus the risk-free rate upon or divided by the standard deviation of the portfolio. So let us just calculate the Sharpe ratio here. Now here the Sharpe ratio it is equal to we are just taking an example over here. We are just taking this minus, we know the risk-free rate is this, divided by the standard deviation, okay. And what we have done is I just want it in numbers, not in percentage, so I'll just put it like this, right. Okay. Now what we want to do is, having calculated the Sharpe ratio over here, the next thing that we need to do is to see as to the higher the Sharpe ratio, you can see the formula. What is the formula? It is the expected return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. There are two things over here. You want to maximize standard deviation. Why? You might, sorry. You want to maximize the Sharpe ratio. Why? Because higher the Sharpe ratio, better it is. So there are two things you will have. One is a higher expected return, because of which the Sharpe ratio may go up, or secondly, the lower standard deviation, because of which the Sharpe ratio may go up, right? So there is a function, you go to data and then you have something called as solver, and set the objective of cell J34, our cell of Sharpe ratio is J34, to maximum by changing what cell. Remember, we have all connected this cell, so whatever, if I change over here, all these values were automatically changing because this was 1 minus this, okay. So I just click over here and I say solve, okay, and the solver solves and tells me that this is the best possible reading, which is -2. So what I do is I just color it. So that, and I can also bring it over here, right? This is where it was. So I will just make the place for one cell to move up, and I just place it over here. I will tell you why I placed it over here, because now this has become the most, okay, this is the best possible Sharpe ratio that you can get. So for a combination of the best possible Sharpe ratio of this risky asset, that is Google and Walmart, the best possible combination is a 2% of Google with a Walmart 98% gives you a 0.387% return with almost 2%, 2.4% of standard deviation, okay. So we take now the risky asset. So what are the things that we need? We need the I calculate for risky asset, RFR and CO. So these are the three things we need to take into consideration: the risky asset, the risk-free rate, and the correlation. Okay. Firstly, we take the readings of expected return reading of risky asset, which is this one, right? And standard deviation is this one. Okay. Even though we started with these two stocks, now this is construed to be a single asset class. Okay, so this is one risky asset class, just for your information. What is the risk-free rate? The risk-free rate is equal to this one, right? Now by definition, risk-free rate doesn't have any standard deviation, so I will put it at 0. And the correlationship between a risky and a risk-free asset is again 0. So again I will put it as 0. Now based on this, let us now calculate as to what is the combination of a risky asset and RFR and the expected return. Okay. So what I'm just doing is I'm just making everything similar. Okay. Let us start this with 0, and this is equal to 1 minus this, and let us just convert it into percentage. Okay. And this is equal to plus 0.1. Okay, and this will be, so this way we go for a few readings. Let us say we go up to 130, 140. So effectively what we start the reading by saying that we start with a risky asset which is equal to 0, right? And in this case 1 plus 0 means everything will be in risk-free. Okay. So what is the expected return of this portfolio and what is the standard deviation of this portfolio? Okay. So let us now calculate the standard and the expected return. In this case, this is equal to the risky asset multiplied by the expected return of the risky asset. I need to fix it, plus risk-free asset multiplied by the returns of the risk-free asset. Okay. I'll just have to bring down the decimals considerably. I'll bring down the decimals considerably, and okay, I'll just make all of them, at least, not all of them, from here onwards. Let me make the column width to be 9 so that it becomes easier for us to see everything. Now I have calculated this. Again, I am just doing F2 to show you. So firstly I took the risky asset weight, multiplied it by the risky expected return of the risky asset, and you can as well be sure that this will be 0, and the second part is the risk-free asset is what is calculated. Now what is the definition of standard deviation? You remember from our previous example? So we said something like this. This is equal to, we said this multiplied by risky asset raised to the power of 2 plus this multiplied by this again raised to the power of 2 plus 2 multiplied by, and this K37 I have to lock it. I have not locked K36, K30. I have to lock both F4. This I have to 4. This multiplied by 2 plus 2 multiplied by risky assets weight multiplied by risk-free assets weight multiplied by standard deviation of risky asset. I lock it, multiplied by standard deviation of risk-free assets multiplied by correlation bracket raised to the power of 1 divided by 2. This gives the standard deviation. Okay. Now just look into this. If I just do F2, what are the interesting things? The interesting things are that almost on all counts this plus part actually vanishes. Why? Because there are zeros. Standard deviation, where there is a standard deviation involved. Okay. So wherever there is a standard deviation involved, K36, K30, L36, L. I have to take, sorry, I have taken mean by mistake. It is L and here to L. Okay. Here to L. L is the standard deviation. Okay. Now the interesting thing is, if you see here, standard deviation of risk-free asset is 0. So this part, the second part, there are 3 pluses in between. The first calculation is between the risky asset and the standard deviation of risky asset, that you will get, there will be some answer. But other than that, plus risk-free asset multiplied by standard deviation raised to any power is 0, because standard deviation is 0. And the third part, 2 multiplied by the weights and all those things, again multiplying by standard deviation and the correlation, which is 0, effectively means that you have to only calculate the first part, that is I42 here. I42 multiplied by I36. Okay. So you can calculate it like this. I just put all those readings here, or you can even put it like this. This will be the same. So if I do this multiplied by the standard deviation of risky asset, okay, because it was raised to the power of 2 and then square root of the same, so it amounts to this. So if I just, and for L36, if I just do this, I am just showing you, you will find that all the readings are the same. So effectively, since the second part and third part amounts to 0, you don't even have to put the full formula. Okay, full formula of your standard deviation calculation. Standard deviation calculation, you don't have to put even the full formula. Okay, I'm just showing it to you. So any which way, either of them is correct, but I mean the one I just now showed and I actually removed. This one is much better in the sense that you don't have to calculate fully. The chances of you making a mistake is very low. Okay. Now having done that, what you need to do is, now you need to insert these values into a chart. Okay. So what do? You go to insert, go to charts, and you go to scatter charts. you can pick something. I will pick up this. Let me pick this one up. Okay, and then I just right click on it and I say select data. I say add, and here I just take the standard deviation of all this reading still here, put it over here. This is in the x-axis. On the y-axis I have all the expected return. Okay, now these two things I have done. So when I do this and say OK, you will have something of a U-shaped, right angled U-shaped curve, as such, parabolic curve. Okay, what does this denote? What does this actually show? This is a chart of a risky portfolio. So on the bottom you have a standard deviation, and on the top you have, on this, in the x-axis you have standard deviation, and on the y-axis you have the expected return. So this is how the risky portfolio is seen. Now to actually explain to you the whole thing, you also need to now apply the risk-free portfolio and the risky portfolio in the same chart. So you superimpose it on the same chart. How do you do that? You do it this way. I'll show it to you. Again you go over here, go and select a chart, say add, and here you copy the standard deviation right from 0, and here in this case you take the expected return of one risky and risk-free portfolio and then just add. Okay, so these are, so this is also called as the capital allocation line, and you can see the capital allocation line hitting the tangent of this parabola of risky assets, and that is the place where the Sharpe ratio is supposedly the best, where 2% of Google and 98% of Walmart is what is the combination that they are talking about, right? Okay, now since the other interesting thing is that I will add a few more things here. I will just copy this. Okay, I want to, these are called, all the dots below this are actually called as inefficient frontier. This is the efficient frontier, and this side is called, this side is called as the global minimum variance portfolio. Okay, so what I am trying to do is I need two more things to be set over here. So I will select, add another series over here for this data from wherever it has been looking good or efficient, and this data. Okay, just a minute, something went wrong. Okay, I'll first of all add the standard deviation and Sharpe ratio, and then I will add another series there is some, okay, all the same, I will show it to you in the other chart. Okay, so I have done this, so I have calculated and done this over here. You can see over here, so this is the Sharpe ratio, where the Sharpe ratio was the best. It is the same reading as such, okay, as the one that I have just shown you. Okay, so this is the risky portfolio. This is called as the inefficient frontier. This is the efficient frontier, and capital allocation line. Capital allocation line is nothing else but the line that is leading to the Sharpe ratio as such. And a combination, this is, if suppose you start from here, this is 0 standard deviation. So this is the type of return on risk-free rate or risk-free asset that you're getting. Suppose you want to buy something with a 2 standard deviation as such. This is the place where 2 standard deviation with a combination of risk-free and risky assets can be taken. So if suppose here, let us say the combination of 2 standard deviation, okay, somewhere around here, okay, I mean you can also calculate. So here it is saying that with 80% of, or somewhere around 80 and 90% or 83-84% of risky assets and 17%, somewhere around, if suppose it is 83, 80+% and 20- of risk-free assets you take here. And when you are taking into consideration 80% of risky assets, what does it mean? It means in the same combination. So if suppose it is 98 here, when you are calculating risky asset, it was 2% for Google and 98 for Walmart. In the same proportion, this 80% will be in the same proportion, and accordingly this will reduce. Okay, so you will have 20% or 17 to 20% of risk-free assets, 80 to 83% of risky asset, out of which it will be in the same proportion here, and that will form a portfolio which gives a standard deviation of this, and in this slope line, whatever it is, it will give you what, 3.5 or 0.35% weekly return equivalent. Okay, this is the efficient frontier. And what is the meaning of inefficient frontier and efficient frontier? Very simple. For somewhere around say a 3% or a 3.205 standard deviation, you get a return of 0.2847. Now if I just go up correspondingly here, for a similar type of standard deviation, I get a much higher return of 0.4251. That is why this part of this curve is called as the inefficient frontier and this part is called as the efficient frontier. So that's it from me, and let me stop the recording here. Thanks everyone.